We've got another royalty-related transaction, folks, but this latest deal is a bit smaller in size than we've grown accustomed to. Not everyone can be a big fish in the pond, but that's okay too. This transaction, however, is a bit different from what we've seen amongst peers. Rather than a big merger or massive buyout, this latest deal is just focused on heavily growing the portfolio of a royalty name, with this transaction tipping the scales of the portfolio towards being precious metals focused, which means the potential for future inclusion on precious metals focused indexes. We're talking Vox Royalty and what they're referring to as a transformational transaction. Let's dive in. Vox Royalty is set to pay up to $60 million to acquire a portfolio of assets from a subsidiary of Deterra Royalties. This isn't your typical royalty and streaming portfolio that is being acquired, however. Rather, this is a portfolio of 10 gold offtake and royalty assets, which covers a total of 12 mines and projects across 8 global jurisdictions. The purchase exposes Vox to a number of quality names, including Equinox Gold, Allied Gold, B2 Gold, and Goldfields, alongside assets operated or previously operated by i-80 Gold, Victoria Gold, and Aurus Resources, amongst others. But if we're being honest about it, Vox does a terrible job of explaining exactly what they've acquired, and well, we'll get to that in a minute. Our concerns aside, the portfolio is said to be accretive on a number of metrics, including revenue per share, cash flow per share, and net asset value. Revenue for calendar Q2 from this portfolio of assets is said to have amounted to $5.6 million, while the trailing 12-month revenue sits at $16.3 million. Revenue per share for Vox is expected to increase by 115% as a result, which is a sizable improvement. And on cash flow, immediate cash flow from the transaction comes from a total of 7 operational mines, with obvious potential for expansion with further exploration, life of mine extensions, and throughput enhancements on site. Furthermore, the portfolio is providing access to over 300,000 ounces of physical gold per year, which is based on full year 2025 exposure to 338,000 ounces of delivered gold and full year 2024 exposure to 306,000 ounces of delivered gold. Where things falter is margins. Margins on a per ounce basis in the first half of calendar 2025 have totaled just $63.10 an ounce, which for something marketed as a royalty-related deal is head-scratchingly low, especially in this gold environment. Alright, by now if you're a long-term viewer, my hope is that you're asking me 2 key questions. First, how was Vox able to get exposure to 338,000 ounces of gold annually for just $60 million when the nominal value of all that gold at current prices is in the area of $1.25 billion? And secondly, what the heck is with the margins? This all goes back to the comment that Vox explained this deal extremely poorly. If you're reading the news release and get to the section entitled Portfolio Summary, you might be led to believe that this transaction, which was billed as a royalty and offtake deal, will see Vox entitled to receive 100% of gold production from Equinox's Greenstone project for up to 58,500 ounces of gold per year. Or that they'd receive 35% of gold produced across Equinox's Fazenda, RDM, and Santa Luz mines until 658,000 ounces are delivered. Or even that they'd receive up to 50% of gold production produced by Allied Gold at Benicro, which is for an uncapped amount of gold. But you would be at least partially wrong. The portfolio being acquired in total includes just 2 royalties. A 3% gross revenue royalty with an effective rate of 1.04% on Goldfields Exploration St. E's project, and a 1% NSR on B2 Gold's development stage Dandoko project. The remaining assets acquired under this portfolio consists of 8 offtake agreements in total, which might be something you are entirely unfamiliar with. So what is an offtake agreement? Well, this is best explained by Deterra Royalties, the entity that sold the asset package to Vox in the first place. Offtake arrangements, at least of this nature, provide an entity with royalty-like exposure. Margins here are driven entirely by the price of gold, the volatility in the price of gold, and obviously production. Under an offtake deal, a holder of the offtake is allowed to purchase a percentage of gold produced by a mine operator. The purchase price is set by reference to certain reference gold prices between a set quotation period, which is typically in the range of 6 to 8 days. The margin that an offtake holder makes is basically the difference between the lowest reference price set during the quotation period and the offtaker's final sale price. So this might sound a bit confusing without an example. In this instance, let's use Vox and their new offtake agreement at Greenstone. Under this arrangement, Vox has an offtake on 100% of gold production up to a cap of 58,500 ounces of gold per year through to March 2027. So let's say Vox wants to exercise the entire 58,500 cap in one single transaction. They call up Equinox and go, "Yo, Equinox, I want my gold. Let's start the 6-day quotation period on my entire allotment for 2025. Now, Equinox responds by saying, yeah, we can do that. Let's start the quotation period today, September 2nd, 2025. Once that quotation period begins, the two entities track the price of gold over a 6-day period. In this instance, gold over the 6-day period traded from a low of $3,470 an ounce to a high of $3,674 an ounce. So on day 7, Vox calls up Equinox and goes, hey man, the lowest price over the quotation period was $34.70 an ounce, so that's what I'm paying for each ounce this go-round. For simplicity's sake, we'll say that Vox then takes delivery of all those ounces on day 7, which would be September 10th, when the price of gold closed at $36.41 an ounce. Vox then gets to record margins of $171 an ounce on each ounce sold from that offtake deal. Obviously, there's some nuance here, because you aren't going to exercise the full allotment in one go typically. Not to mention, there's production-related constraints, but you get the point. The margin, or really the value of these offtakes, is heavily dependent on the price of gold being volatile during the quotation period, particularly only when gold is going up. And there's the other side of it as well, where these arrangements are extremely capital intensive, which can be a big problem for smaller royalty names. Getting back to this transaction, Vox, as we said, is set to pay $60 million to get its hands on this portfolio. Consideration consists of an upfront payment of $57.5 million in cash and $2.5 million in deferred milestones. Funding is to come from an ongoing overnight marketed financing, which is expected to raise up to $55 million in cash, while the company has also upsized a revolving credit facility with the Bank of Montreal. To provide all that capital that is needed for these offtake deals to work. The credit facility itself will see the revolver increase from $15 million to $40 million, while the accordion feature will increase from $10 million to $35 for total funding capacity of $75 million. The purpose of this increase is explicitly stated to be to assist in funding offtake purchases, with the interest rate set at the second overnight financing rate plus 2.5 to 3.5% contingent upon leverage ratios. The acquisition, meanwhile, is claimed to result in 150% revenue growth on a last 12-month basis, moving the figure from $10.8 million to $27.1, and 200% revenue growth on a calendar Q2 basis, which moves revenue from $2.8 million to $8.4, while adding 6 producing assets to the portfolio, bringing total producing assets to 14. This heavy mix of gold-related assets, meanwhile, is expected to result in Vox being included in the GDXJ index in 2026, which should, in theory, meaningfully impact the share price of the company. All right, so let's wrap it up. Is this a transformational deal for Vox? On a revenue basis, yes, but it also substantially increases capital requirements for the company, so those offtake deals can actually be realized. And truthfully, some of them don't have that long of life. But at the same time, Q2 figures saw a revenue run rate that, when annualized, amounts to over $20 million, which for a company that in the last year recorded $10.8 million in top-line revenue is in fact transformational. So I suppose the deal isn't half bad, provided that Vox can be responsible in terms of capital allocation to be able to fund all those offtakes. All right, everybody, thanks for watching. If there's stories you want us to cover, as always, let us know in the comments section. If you want more mining content, check out our website over at TheDeepDive.ca. And lastly, if you enjoyed this video, do me a favor, smash that like button. Maybe you can think about sharing the content. And if you haven't already, maybe think about subscribing. All right, everybody, I'll see you next time.